Stop. Put the other tabs aside for a minute because what you're really about to hear is not background noise, not a random price wiggle, and not one more silver's up 0.5% headline you can safely ignore. This is not a theory, not a rumor, and not another boy who cried wolf moment. It's a signal that the silver market is slipping into a different phase. And the reason you can feel it, even if you don't know the jargon, is simple. When a market is healthy, it behaves like a machine. Smooth, predictable, boring even. When a market is stressed, it starts behaving like an animal. It flinches, it snaps. It lies still for a moment, then bolts without warning. And right now, silver is showing you the body language of stress. Here's the inciting event you possibly not supposed to connect into one picture. China just put refined silver exports behind a licensing gate that went live on January 1st. And at the same time, the paper market is staring down a mechanical wave of futures, selling tied to a major index rebalance from January 8th to January 14th, potentially billions of dollars worth of silver futures. Meanwhile, the delivery machinery is already humming in early January. The biggest silver ETF is still sitting on a mountain of ounces that everyone watches like a reservoir in a drought. And across parts of the physical world, you've got whispers, sometimes not even whispers, about premiums so high they sound like fiction. That does not happen in a calm market. And if you misread what this means, you're the last one moving when the crowd finally notices the exits. If you understand what's happening before the mainstream catches up, you're the one who steps aside before the stampede turns into a pileup. The real question isn't whether silver goes up tomorrow. The real question is whether the system that sets the silver price is starting to fracture, right in front of you. Because I've seen this movie before, just with different costumes. I remember what it looked like when credit markets started to seize in 2008, and everyone pretended it was contained. I remember how quickly liquidity turns from a comfortable word into a desperate prayer. I remember the way exchanges react when volatility starts exposing the plumbing. And I remember the old silver games, the history, the squeezes, the concentrated positions, the tug of war between paper promises and physical metal. When the narrative shifts, it never announces itself with a trumpet. It shows up in small procedural changes, in margin notices, in delivery patterns, in inventory language that only insiders bother to track. It shows up in the places where the public isn't looking until it's too late. So let's walk through the signals, slowly enough that you can see the structure, but fast enough that you feel the urgency. Because this isn't just about silver. This is about what happens when the world tries to run a real economy, energy transition, electrification, defense production, data centers, on top of a financial system built on leverage, paper substitution, and confidence. When confidence cracks, everything reprices. And silver is one of the first metals that tells you whether the repricing is going to be gentle or violent. Start with the move that went live on January 1st. China didn't just say something. It didn't just float a policy trial balloon. It put refined silver exports behind export licensing. And you need to understand what that means in plain language. It means the flow of metal is now subject to permission, timing, and bureaucratic friction. It means shipments can be slowed, redirected, or quietly throttled without a dramatic announcement. It means the supply chain has a new choke point. And choke points are where markets break when demand surges. That's not a headline, that's a lever. And the reason this matters is not because you need to memorize which ministry stamps the paperwork. The reason it matters is because refined silver is not an optional luxury metal anymore. It is an industrial bloodstream metal, solar panels, electronics, EVs, grid infrastructure, high reliability components. And unlike some industrial inputs where you can just flip a switch and double production, silver supply is stubborn. A lot of it is produced as a byproduct of other mining, meaning you don't get to simply mine more silver on command when the price starts screaming. So what happens when you combine stubborn supply with rising strategic demand and then place a licensing gate on one of the world's OS major refining and trading hubs? You get fragility. You get delays that don't show up in the futures price until they were already baked into delivery schedules. You get buyers who can't afford to be wrong starting to front-run availability. And you get governments treating metal like a strategic asset instead of a commodity. This isn't globalization. This is resource nationalism with a polite face. And here it's the part that should make you sit up straight. The world is drifting into an era where free flow of critical materials is being replaced by permissioned flow. That's what export licensing is in real terms. It's a reminder that when things get tight, the rulebook changes, quietly, procedurally, and then all at once. So ask yourself, if the world's industrial base is leaning harder on silver and a major node in the refined supply chain is now operating behind a gate, what happens when a demand shock hits? Do you think the market just shrugs? Or do you think it starts rationing, first with delays, then with premiums, then with outright shortages? Now layer on the second signal, the paper mechanics. From January 8th to January 14th, The Bloomberg Commodity Index rebalance window is expected to force systematic selling of silver futures, potentially on the order of billions of dollars, with estimates that translate into something like a meaningful chunk of open interest. This isn't about someone waking up bearish on silver fundamentals. This is about machines, rules, passive flows, index math. And that is exactly why it matters. Because when the selling is mechanical, it doesn't care about reality. It doesn't care about physical tightness. It doesn't care about whether a fabricator is desperate for supply. It sells because the model says rebalance. That is how you get the most dangerous kind of distortion. A paper price event that can temporarily smash the quote while the physical market is quietly tightening underneath it. That's not price discovery, that's a split brain system. And a split brain system is where the cracks widen. I want you to picture it like this. The paper market is the billboard. The physical market is the warehouse. In a normal world, the billboard and the warehouse move together. The sign says what's inside. When the system is under stress, the billboard can be manipulated, pushed, and temporarily painted over, while the warehouse inventory is being drained. And the people who understand that difference, the desks, the industrial buyers, the serious stackers, don't panic when the billboard flashes red. They watch whether the warehouse is filling or emptying. So what does it tell you when a major index rebalance can dump a wall of futures selling into the market, right as geopolitical and industrial supply chains are becoming more permissioned and more fragile? It tells you the paper market is vulnerable to a smash and grab pattern. Smash the price with paper flows, grab physical quietly, repeat. This isn't risk management. This is an extraction mechanism. And you don't have to be a conspiracy addict to understand incentives. If you can push the quoted price down temporarily with mechanical flows while physical demand stays stubborn, you create a window where real metal can be accumulated without waking up the public. That's how smart money behaves, not with screaming headlines, with calm, timed operations. Now, while the public is staring at charts, the exchange plumbing keeps moving. Delivery notices, settlement mechanics, the quiet machinery that tells you whether contracts are rolling harmlessly or whether more participants are pressing for real metal. When I say delivery, I'm not trying to make this sound mystical. It's simple. Futures are promises. A lot of those promises are closed, rolled, netted, and settled in cash-like fashion. But when a market gets tense, when trust gets thin, you start seeing more emphasis on the actual settlement process. On who issues delivery notices, on who stops the contract, on how quickly activity builds at the front of the month. And early January delivery activity is exactly the kind of place where you look for stress signals, because it's where the abstract meets the real. It's where paper either stays paper or tries to become metal. Now, don't over-romanticize it. The silver futures market can handle deliveries in normal times, but the point isn't that a delivery notice is automatically a crisis. The point is that when other signals are flashing, export gates, mechanical selling waves, margin hikes, physical premium stories, delivery behavior becomes more meaningful. It becomes a diagnostic, like a pulse reading when the patient is already sweating. And here's the thing, the silver market is not huge in the way people assume. Compared to the scale of global financial leverage, silver is a narrow corridor. When too many bodies try to run through a narrow corridor at once, you don't get an orderly line, you get a jam, you get a crush, you get a violent repricing. Which brings me to the ETF reservoir, the one everyone watches because it's visible. The iShares Silver Trust, SLV, is sitting on roughly 528 million ounces in trust as of early January. That number sounds enormous until you translate it into behavior. In tight markets, ETFs become both a pressure valve and a battleground. They're a place where demand can express itself without immediately touching the retail coin market. They're also a place where, depending on how the structure functions and how participants behave, metal can move, at least in theory, between the ETF ecosystem and the broader market. And when you have a mountain of visible metal like that, it becomes part of the narrative war. Bulls point to it and say, look how much metal exists. Bears point to it and say, see, there's no shortage. But that's the wrong frame. The right frame is, in a stress event, visible reservoirs get watched like hawks because they represent potential supply or potential demand, depending on which way the flow turns. If the market is tightening and industrial players start scrambling, people naturally ask, where can additional metal come from quickly? Mines don't ramp on a dime. Refining is gated. Scrap supply has limits. So the eye turns to stockpiles, to vaults, to ETFs, to anything that looks like available. And the moment the crowd starts thinking that way, the psychology shifts. Because then the question is no longer, is silver undervalued? The question becomes, is there enough deliverable, accessible metal at the price being advertised? That's the question that breaks systems, not a forecast. A solvency question. And once you're in a solvency question, the price stops being a polite negotiation. It becomes a rationing mechanism. Now let's talk about the margin hike, because this is one of those signals that looks boring until you've probably lived through a few volatility events. The exchange raised margin requirements on silver futures after sharp moves, pushing the required capital per contract higher. In plain language, margin hikes do one thing. They force more collateral into the system. And that sounds responsible, right? Risk control, prudent management, stability. That's the story. The reality is that margin hikes are also a pressure tool. They can force weak hands to liquidate. They can amplify a move by triggering forced selling. They can punish leverage at the worst possible time. And sometimes they reveal that the system is nervous, because exchanges don't hike margin aggressively when everything is calm. They hike it when volatility is threatening to turn into a cascade. When the models are getting stressed, when the system needs more collateral to feel safe, that's not normal. That's your warning. And if you've ever watched a market during a genuine stress event, you know what happens next. The cost of holding paper exposure rises. The ability of smaller participants to stay in the game shrinks. Liquidity thins, spreads widen. And then, in the thin air, price can gap in either direction. This is how markets go from tradable to dangerous. Now combine that with the index rebalance selling pressure. You can almost hear the gears grinding. Mechanical selling hitting a market where margin costs are rising. That's a recipe for forced movement. A recipe for a paper-driven downdraft, even if the physical side is tightening. And you know what that creates? A credibility gap. The chart might say one thing. The street might be feeling another. And credibility gaps are where people lose faith. Now, let's address the most explosive part of this whole picture, the physical premium disconnect story. When you hear claims of physical premiums exploding, reports of premiums in certain hubs far above normal, talk of spreads that look like the price has split into two realities, you need to handle it with discipline. Not every anecdote is a systemic event. Not every high premium is proof of a global default. But, and this is the crucial but, persistent repeated reports of extreme premiums are exactly the kind of smoke you look for when you suspect a fire in price discovery. Because here's the underlying logic. If paper and physical were perfectly aligned, arbitrage would close the gap. Traders would buy the cheaper form and sell the richer form until the spread normalized. But if the spread stays wide, there are only a few explanations. Either the premium is a localized anomaly with logistical constraints, or the paper price is not fully trusted as a reliable source of real metal in that moment, or the metal that's available is not actually available at scale without delay, restrictions, or counterparty friction, or some combination of all three. And when you are hearing stories about premiums reaching absurd levels in certain markets, numbers that sound like a different universe than the futures quote, you don't just need to accept every number as gospel to understand the message. The message is, the market is arguing with itself. The message is, there are conditions under which the price depends on where you are, what form you want, and how quickly you need delivery. And once that starts happening, you're no longer dealing with a single unified market. You're dealing with fragmentation. Fragmentation is the prelude to repricing, because a market that fragments is a market that's losing its ability to clear smoothly. It's losing the social trust that paper claims are as good as physical. And in a world where trust in fiat is already decaying, where debt is compounding faster than legitimacy, any crack in the paper equals real assumption is gasoline on the fire. So let's put all of this together. On one side, you have a world that increasingly needs silver for industrial purposes, solar demand, electrification, strategic manufacturing, and a supply chain that can't just surge production at will. On another side, you have a major player placing refined silver exports behind licensing, starting January 1st, adding friction and control into the flow. On a third side, you have mechanical paper flows, index rebalances, potentially dumping large futures, selling into a narrow corridor from January 8th to January 14th. Then you have the exchange raising margin requirements after sharp moves, tightening the collateral vice. And in the background, you have delivery mechanics and visible ETF stockpiles acting like pressure gauges and reservoirs that traders watch for signs of drain or strain. And then you have the street-level chatter about physical premiums and disconnects, the kind of stories that show up before the average person notices anything wrong. That's not a single story. That's interlocking stress points. And interlocking stress points create feedback loops. Here, ask what a feedback loop looks like in this context. Paper selling knocks the price down, which triggers margin stress, which forces leveraged players to liquidate, which pushes paper price down further, which creates a psychological moment where the public thinks silver is weak. Meanwhile, the lower quoted price can stimulate physical buying, especially if people see it as an engineered dip. And if the physical market is already tight, those buys show up as delays in premiums. The premium stories spread. The credibility gap widens. More people demand physical. More pressure shifts toward delivery and away from pure paper exposure. Exchanges tighten margins further. Liquidity gets thinner. Then a sudden demand shock or supply disruption hits, and the market doesn't glide into a new equilibrium. It snaps. That's not volatility, that's structural instability. And structural instability is what you get when the market is built on a layered stack of claims and assumptions. And then reality starts poking holes through the layers. Now, I want you to recognize something that most people miss. The most dangerous moments in markets are not when everyone is screaming about crisis. The most dangerous moments are when the institutions are quietly adjusting procedures and collateral rules, when governments are quietly gating exports, when index machines are quietly rebalancing massive exposures, and when the public still thinks it's all just a chart. Because that's when the smart money is early. When the biggest desks start switching their screens to something else and quietly stepping away from one trade, they're not bored. They're evacuating risk. And you might be thinking, okay, but if paper selling is coming, doesn't that mean silver's going down? That's the wrong question. The right question is, what does it mean when the price can be pushed around by mechanics while the physical world is tightening? Because if you're playing for a quick trade, sure, paper flows matter. But if you're thinking in terms of regime shift, in terms of the monetary endgame we're drifting into, then paper volatility is not the story. Paper volatility is the camouflage. The real story is whether the system can keep the illusion intact. That a paper claim is as good as metal, that global supply is free-flowing, that risk can be contained with margin adjustments, that the plumbing is fine. Every one of these signals suggests that illusion is under strain. And once you see that, you start noticing the pattern that repeats through history. In every major financial stress event, authorities and institutions attempt to preserve confidence through narrative first. They call it transitory, localized, technical, a rebalancing, a temporary dislocation, a normalization of risk parameters. Those words are designed to keep you calm. But markets don't break because of words. They break because of arithmetic and behavior. They break when too many claims chase too little collateral. They break when the exit is crowded. They break when the price mechanism stops reflecting availability. Silver is especially sensitive to this because it sits at the intersection of money and industry. It asks the metal that can flip from industrial input to monetary refuge faster than people expect. Gold is a monetary asset first. Silver is the wild card because it can get pulled into both worlds at once. Industrial demand doesn't politely step aside just because investors are nervous. And investor demand doesn't politely step aside just because a manufacturer has a procurement schedule. When both sides pull, something gives. And historically, what gives first is not the metal, it's the paper structure around it. Now, I'm not telling you to panic. Panic is what the crowd does when it's late. I'm telling you to think like someone who understands phases. Phase 1 is denial. Everything is normal, headlines are noise. Phase 2 is distortion. Paper and physical start telling different stories. Phase 3 is intervention, margin hikes, rule changes, export gates, temporary measures. Phase 4 is repricing. The market discovers the real clearing price under stress, and you don't want to wake up in Phase 4 still thinking you were in Phase 1. So ask yourself, honestly, what phase does this feel like? China doesn't boom whap, put refined silver exports behind licensing on January 1st, because everything is comfortably abundant and apolitical. Exchanges don't hike margins after sharp moves because volatility is healthy. Index rebalances don't matter unless the market is thin enough that mechanical flows can move it. And premium stories don't catch fire unless the physical side is feeling friction. This isn't a dip, it's a dress rehearsal. Now, let us talk about what this means for you in the only way that matters. Paper versus physical, claims versus collateral, convenience versus certainty. If your exposure to silver is purely paper, purely a claim, then you need to understand what you actually own. In calm times, paper exposure tracks price. In stress times, paper exposure can be subject to spread widening, to forced liquidations due to margin, to counterparty friction, to rule changes, to settlement mechanics. That doesn't mean paper is worthless. It means paper behaves like a financial instrument inside a financial system. And the financial system is what's under strain. Physical metal behaves differently. Physical metal doesn't care about margin hikes. It doesn't care about rebalancing windows. It doesn't care about the exchange's collateral rules. Physical metal cares about one thing: availability. Can you get it in the form you need, in the time you need, at a price you consider acceptable? And if availability starts to tighten, physical doesn't gently go up a little. It tends to gap via premiums, delays, and rationing. That's the part the mainstream avoids because it's hard to put on a chart. It's hard to narrate on TV. But you and I both know reality doesn't need a TV anchor to validate it. Reality shows up at the counter. Reality shows up in delivery times. Reality shows up when the quoted price says one thing and the actual transaction says another. So ask yourself, if you had to convert your price exposure into real metal during a period of stress, how confident are you that you could do it cleanly, quickly, and at the price you thought you were entitled to? That's not a comfortable question. It's the only question that matters in a regime change. Now, I want to underline something about the January 8th to January 14th window, because timing matters in markets more than morality. When a market knows a flow is coming, the smart players position around it. They front run it, they fade it, they use it. They don't sit there like a deer in headlights. So if there's expected mechanical selling pressure in that window, you should assume the sharks are already circling it, not because they have a crystal ball, but because they can read the calendar. And what happens when you have calendar-driven selling in a market already crackling with supply chain and policy friction? You get volatility that looks irrational to outsiders and looks like opportunity to insiders. That's when the narratives get weaponized. If price drops, they'll tell you the silver shortage story was nonsense. They'll tell you demand is weak. They'll tell you it's just another commodity. They'll use the dip as a psychological operation to shake confidence. And if you're not mentally prepared for that, you'll do what the crowd does. You will confuse short-term paper movement with long-term structural change. Don't make that mistake, because the endgame dynamic here is bigger than a single week of rebalancing flows. The endgame dynamic is that the world is drifting into a scarcity and control era. Scarcity of real collateral, control over strategic commodities, and a financial system drowning in debt that requires ever more confidence to keep rolling. Silver sits right in the blast radius of that endgame. And that's why these small procedural shifts matter. They're the early tremors. They're the fault lines moving before the earthquake. Let me give you a simple analogy. Imagine a dam holding back water. In phase 1, the dam looks fine. In phase 2, you see tiny wet spots. See page. In phase 3, engineers start restricting traffic on the bridge over the dam and quietly moving equipment nearby. In phase 4, the dam fails and the water doesn't politely rise. It surges. Export licensing is seepage. Margin hikes are engineers restricting traffic. Mechanical selling flows are the water pushing unpredictably. Premium disconnects are the locals saying the river feels wrong. And delivery activity is the pressure gauge twitching. So again, what phase does this feel like? Now, I'm going to say something that might make you uncomfortable, but you need to hear it. The most dangerous thing you can do in a late cycle system is outsource your understanding to official narratives. Because official narratives are designed to preserve calm, not preserve your purchasing power. They will always tell you it's contained until it isn't. They will always tell you there's plenty of supply until there isn't. They will always tell you the market is functioning until the day the rulebook changes. And the rulebook always changes when the collateral runs thin. Silver is collateral in disguise, industrial collateral. Monetary collateral, strategic collateral. And when collateral becomes political, the market stops being purely economic. It becomes a power contest. So here's the decision framework you should carry in your head as this unfolds, without me telling you what to buy or sell, because that's not the point. The point is how you position mentally so you're not emotionally ambushed. If you're exposed only to paper, understand you're exposed to the system's plumbing. If you have physical, understand paper volatility can be noise and sometimes a gift, because it shakes out weak hands while the structural forces keep tightening. If you're watching from the sidelines, understand you don't get a polite invitation when the repricing begins. You get a gap, a scramble, and suddenly everyone is talking about the thing you could have prepared for when it still felt boring. And most importantly, understand that the price on the screen is not the same thing as the cost of certainty. The cost of certainty is always higher. It just becomes obvious during stress. Now, a quick word, just one, about staying close to signals like these because they won't lead the evening news until after the move is over. If this kind of stress marker matters to you, stay near the data, not the commentary. Watch the procedures, watch the rule changes, watch the delivery tone, watch the physical market chatter. Because by the time the mainstream starts using words like shock and unexpected, the positioning opportunity is gone. Back to the story. Where does this go next? If the export licensing gate creates friction, you may see regional tightness and premium pressure build in places that rely on specific supply routes. If the index rebalance selling wave hits and pushes paper price down, you may see a psychological attempt to declare the silver story dead, right when the structural pressure is actually building. If margins remain elevated or rise further, leveraged participation can shrink, liquidity can thin, and price movement can become more violent. And if physical premium stories persist and spread, you may see a growing class of participants who no longer trust the screen price as a sufficient signal of availability. Now, if those stress points line up, you don't get a gentle repricing. You get a snap. You get the kind of move where people look back and say, how did this happen so fast? And the answer is always the same. It didn't happen fast. It happened slowly, then all at once. Slowly, a licensing gate here, a margin hike there, a mechanical flow window on the calendar, a few unusually loud premium reports, a few delivery stats that catch the eye. Then, all at once, the crowd realizes the corridor is narrow. And once the crowd realizes that, you don't get orderly, you get chaos. Because silver is a small market relative to global capital. It doesn't take the whole world piling in to overwhelm the available float. It takes a shift in psychology, a shift in trust, and a shift in preference from claims to collateral. That's the regime shift, and it is the same regime shift you see in the broader monetary system, from trust in paper promises to demand for real assets, from faith in centralized narratives to personal risk management, from "it'll be fine" to "show me the collateral." So watch the calendar, watch the licensing gate, watch the exchange collateral rules, watch the physical premiums, watch the delivery pulse, and above all, watch the credibility gap between paper price and physical reality. Because when that gap widens far enough, it stops being a trading story. It becomes a legitimacy story, and legitimacy is what fiat systems run on. When legitimacy decays, people don't politely rebalance portfolios. They flee, not a forecast, a pattern. And you've seen it before in other places, other assets, other crises. The early stage always looks technical, the middle stage looks volatile, and the late stage looks inevitable. But only after the move is already done. You don't have years to think this through. You barely have months. And in moments like this, when multiple stress signals cluster into the same narrow window, sometimes you only get weeks. So here, that's the final question I want you to sit with as you go back to your day. Are you watching silver like a chart or like a warning light? Because a chart can lie to you for a while. A warning light can too. But when enough warning lights come on at the same time, you don't argue with the dashboard. You pull over before the engine seizes. And right now, silver is telling you something with its policy gates, its paper mechanics, its collateral tightening, and its physical whispers. Ignore it if you want, but don't pretend you weren't warned.